Welcome back to Boutiques on Wednesdays. 101 Dalmatians since Trump took office, and our heads are still spinning. Some would say that these first 100 days in office are very impressive, but if you are an investment manager, you are very likely on the opposite side of that. To name but a few, he closed the borders, energy prices are dropping, which is good for inflation, by drill, baby, drill. He got rid of DEI, and that also explains somewhat his dislike in SA. He added 90,000 manufacturing jobs to the US economy. But he also scrambled markets with tariffs and created strategic uncertainty to make deals. And we've seen approximately 70 countries came to the negotiating table, and markets are turning green as soon as it appears as if deals are being made. But some still warn of a continued looming recession, with the IMF downgrading growth for most countries, including South Africa. On the local front, we have crazy politicians all claiming credit for the VAT increase not going ahead, or acting like little children. We don't have a stable government in place. We still have a weak economy, and little being done on implementing a plan for real growth. With such uncertainty, a lot of clients, and you might be asking, should we buy? Should we sell, or should we just sit tight and see what happens? How should South Africans invest in this environment? With that said, it's my absolute pleasure to welcome our experts this morning. My absolute pleasure to introduce Chief Investment Officer, BlueAlpha Investment Management, Walter Jacobs, on the line already, and Liam Dawson, Investment Analyst and Portfolio Manager at PortfolioMetrix. Good morning, gentlemen. How are you doing?
Morning, Eugene. All good, thanks.
Fantastic. Walter, to both you and Liam, thank you so much for your time this morning. I know things are hectic back at the office. This is a short week. No holidays, no breaks for us. I see a lot of clients on the line, but of course we all want to know what you are doing in your multi-asset funds. Walter, you up first. You can start sharing your presentation if you're ready, followed by Liam. To our audience who know how it works by now, the Q&A bubble. Please post questions as we progress, and we will try to cover as most of that as we can after both presentations. Walter, I can see your presentation. If you're ready, we're ready for you.
Okay, thanks, Eugene. Yeah, so I've titled the presentation "Time to be Greedy" or "A Time to be Fearful." And yeah, I mean, as you rightly unpack the macroeconomic scenario, there is really a lot of uncertainty, and so the time to be fearful or time to be greedy really comes from Warren Buffett, one of the most successful investors globally, who famously said, "Be fearful when others are greedy, and be greedy when others are fearful." So I'll unpack that in the next coming slides, but just a reminder about BlueAlpha. I mean, we've been around for over 20 years, founded in 2003, and we've had multiple awards for some of our equity funds. The funds that we have, our unit trust offering, basically 3 multi-asset funds and 3 equity funds, all in existence for quite a while. And the one multi-asset fund that we manage, Select BCI Worldwide Flex, is obviously a BCI fund that we manage on your behalf. But enough about the funds. Back to Warren Buffett. So it really sounds easy, be fearful when others are greedy and be greedy when others are fearful. But what are we supposed to be right now? Are we supposed to be fearful, or are we supposed to be greedy? And really, does the same thinking apply to everything? Does it apply to US and Europe equities and to South African equities? And what about other asset classes? I mean, the market is full of these sayings that is supposedly useful, a useful guide, but in my mind, probably causes a bit more confusion than actually being a guide. And so just thinking about some of the things that you mentioned, Eugene. So there's lots of reasons to be fearful. I mean, I said risk is a name, and the name is There's actually two names. Donald J. Trump, US president, whose tariffs on, tariffs off policy, tariffs to double, tariffs to reprieve our own government of national unity, where talk is, is it still on? Is the DA leaving? Is the DA staying? VAT being introduced, VAT hike being introduced, VAT hike off. So just what do you do in all of this toxic mix? So what I will say is that we have to remember that the companies that we invest in and their CEOs see all the same noise that we do, and their job is to run a business that is sustainable in the long run. The difference with them is that they're at the coalface, though. They experience firsthand what these tariffs and VAT hikes do, how consumers behave, because they see it firsthand, and they structure their businesses, successful ones, to be sustainable in the long run and still make profits. So is it the time to be fearful? I mean, there's no shortage of indicators that point to extreme fear. And for US equity markets, the stellar performance over the last number of years and valuations at multi-decades highs have resulted in volatile share price behavior when we have these news events and company results that either miss by a couple of points or exceed by a couple of points. And then this can be demonstrated by looking at the VIX. The VIX has basically spiked. The VIX on the S&P has spiked to like the second highest in history since it's been measured. And the Morgan Stanley Global Risk Demand Index is also in fearful territory, and to the extent that it hasn't seen since the COVID crisis. And so what we have to remember again is that COVID has taught these companies many lessons and has basically stretched supply chains to the effect that it hasn't been done in the past. And so companies have a near-term indicator of how to behave and how to overcome these extreme risk events. And so is it a time to be fearful? Warren Buffett says climb in when everybody's climbing out. So what we can see is from survey data that intentions to be overweight US has completely disappeared. So people are looking to be the main investors and large investors in the US, with exceptions, are looking to be underweight the US. And at the start of the year, when you asked, when Bloomberg surveyed fund managers and analysts, they all expected the S&P to be higher by year end. And now, with few exceptions, most are forecasting a lower S&P. And what we can also see is that there's been extreme inflows into gold, which is typically as a sentiment indicator that people are uncertain, that people are fearful, that people are risk averse. So these two would say, be greedy. The previous ones would say, be fearful. Let's just also remind ourselves about a few facts. To be a bear on equity markets really does not pay long term. So time is your friend when you're an equity investor. And so if you look at the first set of charts here, as time progresses, your chances of a loss on the S&P drops quite dramatically. So, holding US equities for a 10-year period, you have a 5% chance of negative returns. So that's pretty low. I mean, if you look at the equity markets over time, the price returns per decade since the 1930s, the S&P has done 23,000%. That's a large number. If you missed the best days because you were afraid of what's happening at the macro and at the noise levels that you typically see in markets, your returns would have only been 67%. So a massive discrepancy between staying invested versus trying to avoid these noise events that happen in the market. And of course, if you have perfect sight, I mean, if you can exclude the worst days, you know, you do a lot better. You know, exclude the worst days, but still have the best days. Then, yeah, I mean, the returns look completely different. But that is just not attainable. There's not people that generate these levels of returns, which will tell you that it is virtually impossible to do. So the best thing to do in US or in any equity market is just to remain invested and wear these risk events that will happen, and some of them will be known and some of them will be unknown, and just not panic. And typically what you see is before the best days, it is normally, you know, quite negative. So the extreme risk events will tell you, you know, that's the time to actually be invested in the business. So 3 months prior to the best days, you know, you have an 11% drawdown on average in equity markets. 1 month prior, 8%. So typically it's darkest before the dawn. So, you know, with all these negativity around in markets, with all these risk events happening, you know, don't be sucked into disinvesting at exactly the wrong time. So what do we do at BlueAlpha? I mean, we're not macro forecasters, so we don't try and forecast these risk events, these changes in government, you know, whether the GNU is going to last or not, whether Trump is going to increase tariffs, double tariffs, or is he going to do reprieves. What we do is we focus on quality businesses that can grow, that generate economic profit. And I'm going to show a couple of these to you right now. So, you know, it's time to focus on the fundamentals. And one of the great businesses that's held through all of those portfolios that I've showed you in the beginning of the presentation, in our multi-asset funds, in our equity funds that has offshore equity, Alphabet is one of the names. And what I want to focus on first is just the economic profit over time. So the economic profit over time has been stellar. I mean, so that tells you it can grow at a return on capital in excess of its cost of capital. The other notable thing is that 50% of its revenue is from outside of the US. And you know, what do we think? Does uncertainty going to make you search less on Google? Is uncertainty going to make you watch less YouTube? Or are you going to watch more YouTube because of this? And AI, is AI a problem for Alphabet? Well, you know, Alphabet's got its own AI, and has been investing quite heavily in that. And despite that, it's growing economic profit. And despite that, it's got really good cash flows. And if you look at the valuation, which most people will always bring forward when they talk about US companies, if you look at an economic yield, it's actually, the valuation is quite compelling. So the higher this line is, because it's a yield, so it's the inverse of a PE. Its economic yield is actually quite attractive, and it hasn't been this attractive since 2015. So again, tariffs is probably more easy on goods that's being produced. You know, you can hit people with tariffs when things come into the port. You know, there's a lot more controllable on real hard assets moving around the world or inventory moving around the world. It's less easy to impose these tariffs on things that's software, that's intangible, that's moving in the cloud. Very hard to contain this type of product. And it's also quite important to remember that for all these US multinationals, which we typically invest in, and we're not invested in all of these names on the screen, we're invested in the predominance of them, but being US listed does not equal all US revenue or all US profit. So a company like Broadcom, which is in our portfolios, only 25% of its sales come from the US. And similarly, something like Visa, 39% of its sales is in the US. So, you know, let's not forget that it's not just about what is happening in the US. It is what is happening elsewhere. And these companies that we typically invest in is dominant US businesses that has got profits coming from all over the world. And that has got a very wide moat. And so we're happy to be invested in them for the long run. But whatever you talk about US companies, the same applies for non-US listed nationals. So if you're looking to run away from the US and hide in something in Germany, like SAP, I mean, 32% of its revenues is also from the US. So going to these other large multinationals that's listed in other markets, they typically also have exposures to the US. So, you know, I really think it's not worth trying to do that exercise. What is best to do is to understand where profits, you know, whether the companies make profits in excess of their cost of capital, and whether they have large moats, and whether they can grow. And that is a much better strategy to follow than trying to time the markets and the risk off sentiment and the risk on sentiment. So, you know, there's a time to be fearful, there's a time to be greedy. Stock market cycles appear to be getting shorter. Over time, it does not pay to be an equity bear. For successful timing, you need both entry and exit correct, and that just doesn't happen on a consistent basis. So companies, successful companies, they see all these cycles, they've managed through it, they've been successful through it, so just stick with them. They see the same headlines as we do, they deal with it at the coal face. Over time, it pays to be invested in equities, and the same goes for South Africa or for the US. And I'll just leave you with these three companies that is listed in South Africa that has over time showed a ability to grow their economic profit over time. And you know that if you can grow your profits over time, you'll do well in terms of your price on the stock exchange. Over time, the fundamentals of the business is supporting the valuation, and these companies tend to valuations improve over time. And that's all that you want is that fundamentals backing your process. And you know, over time, you won't invest in a business that will go under and be negatively impacted by the macroeconomic events. And so that's me, Eugene.
Walter, thank you very much. If you can stay on the line, we're going to take a couple of questions afterwards. You can stop share, then Liam can start sharing from his side.
Thanks, Eugene. Got that screen up, just if you can confirm.
Yeah, perfect. Thanks, Liam.
let me jump straight into it. Thank you, Walter. So it's actually quite interesting because some of the things I'll be speaking about is very much the same as what Walter is speaking about. Some of the core tenets to how we invest, again, very, very similar, but we express it very differently. And that, I think, ultimately is what makes a market. There are very, very different perspectives and views, and they each go and price different assets. What I'm going to be speaking about today is more on the theme of when elephants fight, it's the grass or the reeds that suffer. And I liken South Africa to being one of those blades of grass. And so whilst we might hear a lot of noise about how South Africa has gone and angered the US, yes, there are some elements there of truth, but the special mentions aren't necessarily the only driving factor there. So how do you as a South African invest in this world of uncertainty, and specifically with this trade war going on? And this is, of course, the US and China and the trade war that cannot be won by either party. Both will suffer costs as well as the rest of the economy. So I'd rather unpack some of the facts that we have addressing Trump, tariffs, populism. There are, of course, facts at this point in time, and they change quite dramatically as we go. But one of the most interesting things that have happened recently is, of course, Liberation Day, and you'll notice it's in inverted commas. Unfortunately, the date was the 2nd of April rather than the 1st of April. And I think that is quite relevant as well, because the way that it had been rolled out, this fancy equation on the left, all of those things, it's actually a very, very naive way to approach global trade. It's a disruption to a global economy that the US has benefited from. Free trade has been a huge growth driver for them. And they've certainly benefited from it, despite some costs, which seem to be the focus at the moment. But what I'd like to emphasize off of this chart is something such as China, where you've actually got this number blocked here quite fortuitously, because that's been changing all the time. European Union, Switzerland, South Africa. So why is Switzerland there? Well, if you take a look at the reciprocal tariff that they've received, it's 31%. 1% higher than South Africa. So the question around this is why would Switzerland, the famously neutral country, receive a higher tariff than us? I think we need to ask whether that 30% number is truly reflective of South Africa and the geopolitics, or is it just this very simple equation on the left? Looks complicated, but it is very, very simple with a linear relationship on essentially trade deficits. So moving on from that, what does this trade war actually look like? And there are plenty of memes. Of course, the world's putting AI to its full and best use. And so, like a lot of the true, it's almost most true words said in jest. And you can see it through a lot of these, where on the right here, you've got a Make America Great Again cap, which is made in China. And as the tariffs were rolled up, the price was increased each time, which is quite funny in itself. But there are some very critical, important things going on in this trade war. And it's in short, what does the US have that's critical to China? It cannot easily be substituted. And what does China have that the US cannot easily substitute? So the US has a very large consumer. They've also brought in a fair number of products from China. But the key elements to Chinese trade is in fact the rare earth minerals that they have. They've managed to step up their trade, their high-tech equipment, their ability within AI, as we saw with DeepSeek, which seems like that was a very long time ago. But the advantage that the US has in R&D and tech has eased, or at least the gap has been closed by China quite aggressively. Whereas Chinese control over rare earth minerals and the processing and refining of that is certainly a key advantage to them. But I think the challenge in all of this is looking at who the winner of this war is going to be. And as I said at the beginning, no one is going to be a winner of this trade war. It's not going to be beneficial for global growth, and most likely not going to be beneficial for either China or US consumers and economy. And you've seen that with a fall in business confidence and the like. And I'll unpack one or two of those. But first, of course, you've got two very different political environments coming up against each other. And so what we'd likely see there, without forecasting too much, is essentially a start of a deal. And you've seen Donald Trump backtracking on some of the numbers that he stated, saying it was never going to be that high. You've had some very quiet responses from the Chinese. it is interesting to see these two different approaches to foreign policy. We know that it's radically uncertain, but the question is, what does that actually mean for the global economy? How does that feed through into companies and bonds? Because of course our portfolios have that in it. How does it feed into currencies? And what does that ultimately mean for investors? And I think that's really important, and that's what we need to get to. We need to be able to draw that line between these macro events and the impacts they're going to have on investors' portfolios. So the first one to look at is generally bonds and equities enjoy growth in the economy. These Morningstar charts here show their forecasts in March this year, so before Liberation Day, and then the dark blue lines show their inflation forecasts after Liberation Day. And you can see how at least over the next 2 or 3 years, growth is expected to be lower. Lower growth in the global economy, reflecting those frictions and the trade war that's going on. When we then take a look at the inflation forecasts, you've got forecasts in March and you've got forecasts in April after Liberation Day. And inflation is running higher. And the challenge with that is, in short, prices are going to be higher. You see a lot of questions around the trade and specifically freight sent from China to the US and the potential implications that's going to have on the US economy in a few weeks' time. And then, of course, all of this then rolls up into what is the Fed actually going to do? And if we park political issues aside, the Fed is actually going to have to choose, are they going to prioritize fighting inflation or supporting growth? And the challenge in all of that is that they conflict with one another. One policy action is not going to address both of those in the right direction for them. So they will have to make a very difficult choice at some point, and that might not be a politically favorable choice either. So in summary, what's happening with these macro economic measures? We largely expect lower growth. And I think my only concern around these is that it's largely consensus across all economists, but lower growth, higher inflation, and in particular, uncertain rates. And that uncertain rates is perhaps the most important thing here, because slightly lower growth doesn't mean recession. Slightly high inflation doesn't necessarily mean that markets sell off incredibly. The uncertain rates means that there isn't a lot of certainty in where things are. And that's what this chart here reflects. What it shows you is economic policy uncertainty. The higher the number, the more uncertain economic policy is. And why that's important is that if you're a business owner, whether it's listed or not, and you're choosing to invest for growth, you might choose not to until the climate is just a little bit more certain. Add to that, if you take a look at the levels that we're sitting at on this, and I believe this was to the end of April, sorry, not the end of April, to the beginning of April, and you roll back here, you can see that previous levels that were hit were events such as COVID, which is almost a long, drawn-out market correction recession that never happened, and equally so the GFC, which was one that actually did happen. The difference between now and COVID times, I suppose, is that you had global coordination across central banks and governments. Now you don't have that. In fact, you have the opposite. So what the market has done, and what you saw in Walter's slides earlier, was essentially the market has said that they want gold. You've seen central banks such as Poland buying more and more gold, but the effect this has had is to drive the gold price extremely high. And this is really a reflection of the radical uncertainty in the market. But you need to be careful, because gold doesn't always serve as a risk-free asset. It serves more as an alternate asset class. A risk-free asset doesn't typically run through 50% corrections at times. And so then you need to ask yourself that if you're buying gold at this point, are you buying fool's gold or are you buying a true hedge? And I'd be very cautious about portfolio managers who are buying gold right now, except to say that the financial system might be falling apart, in which case portfolio strategies might not be exactly what you need. And that's not what I'm saying is the case. I'm saying that's the implicit statement made with that. So I'm going to move on in a moment, but what I do want to say here is that the last time commodity prices rose so high, it was in fact very good for South Africa. So perhaps we should take a look at this rising gold price and say that maybe South African assets and our rand exchange rate might benefit from some of these macro shifts. So let's never let a good crisis go to waste. And ultimately, what should investors do, and in particular South African investors do, when panic strikes and uncertainty reaches such levels? So let's reflect on the last example, and that was COVID. 5 years ago, at the end of March, we just had some Fed support in the market, and of course, markets began to correct, even though there's some sell-off in April 5 years ago. But by and large, the world changed. Markets sold off a lot. You had floating hospitals and massive sort of hospitals built in China, for example, if you remember that. You had absurdities such as the future prices of oil going negative, reflecting the ability to store oil rather than the value of it. And of course, a fall down in prices due to loss of demand. Donald Trump was in his first term, very, very different scenario to what we experience now, even if some of the similar markers are still there. But by and large, and this is the message for investors, is if 5 years ago you decided to sit on the sidelines in cash or bonds, and remember this is dollar cash, dollar bonds, you missed out. You could have bought any one of these, whether it was emerging market equities, Japan, Pacific X, UK X, European equities, or US equities, and you would have been far better off than being certain. You need to be careful because certainty comes with a price. This touches on some of the stuff we saw earlier, but some of the biggest drawdowns in markets are in fact common features in a market. You can see through calendar years here how often you get a 10% drawdown and how often you get a minus 20% or more drawdown. Of course, GFC was in particular very deep drawdown. This measles chart here by JP Morgan is an interesting one. And what it does is looks at in gray, your calendar return for the year, each calendar year in the US since the 80s. And the red dot shows you that intra-year drawdown, which is very interesting because if you take a look at some of these values, you had a minus 34% point during that year at some stage, yet you ended the year up 2%. Similarly, over here, we didn't get as much of a recovery during GFC, yet you're still about 10% better than the lowest point. And a similar thing goes across the board. You typically end the year far better than the lowest point in the year. So that would, by reason, say you should not sell at the lowest point. And this is another thing that goes to support it. What you have is a very busy chart, but a gray line running here, looking at US consumer sentiment. Low means that sentiment is incredibly low. High means that everything looks rosy and people are confident. And the subsequent 12-month return from these points averaged 24% when sentiment was low and only about 4% when sentiment was very, very high. So what you're looking at here is a contra-indicator. When you feel bad about markets, when markets feel most uncertain, that's certainly the time to be a lot more greedy. And this chart, in short, starts to lead into the behavior gap and says what you need to focus on is the longer term. You need to try and look through things, because if you'd done that in COVID, you would have been far better off. If you took drastic action in your portfolio, you inflicted permanent damage to it. So let's wrap this up with a sense of how do you keep your balance while the ground is shaking. And I'm going to use the PortfolioMetrix balanced fund strategy to demonstrate that. We unitized this about 5 years ago, and one of the key tenets inside it is this idea that we don't strongly believe in forecasts. Forecasts are a bit of a fool's game. You can make these grand forecasts, but the data suggests you're going to be wrong. And something that Walter said towards the end there is you need to be able to forecast your entry and your exit. But I'd add a third layer to that and say you actually need to identify which asset class you're going to buy as well. And the challenge with that is if you're right 51% of the time on each one of those decisions, on average, you're wrong 87% of the time. So forecasts aren't a great way to go about it. And having huge confidence in those forecasts is even worse, because you're going to mislead and mismanage clients' money. Why that matters is because for an equal gain or equal loss, it's perceived extremely differently by investors. And so you will lose investors if you have these deep drawdowns. Plus 10% on a portfolio is a job well done, minus 10%, and you now need to defend why you still manage money on behalf of investors. And this is an example of South African balanced funds, where you have a fact sheet return here over 14.5 years since our inception of the large balanced funds. that is in fact what the investor got, and that's the behavioral cost. And there's a lot that we can do to talk about that, but of course time doesn't allow for it. So keeping it simple as well as making it simple, we want to package it and make it very, very simple on the surface, but the way that we manage risk underneath is not that simple. And I'll run through these slides quickly through different time periods, but in 2018, when you had Trump 1.0, interest rate hikes, in short, you had a risk-return scatter of all the CISA funds in the background, averages in that line, and the PortfolioMetrix range focusing on the balanced fund over here. If you look at it during COVID-19, exactly the same, similar, consistent, reliable behavior. You can run through the Ukraine invasion, where the world was uncertain and the rand hit 1460 at one point. Similarly, state capture, which seems like a distant memory. We've behaved in a very consistent manner. But if you consistently chip away at this middle of second quartile position, ultimately it means that versus the Allen Greys and Coronations and all these other large balanced funds with great reputations, we're reliably predictable and outperform over the long term. That middle of second quartile, that tortoise versus the hare type strategy ultimately leads you to good long-term performance. So I'll leave you with this last quote here and say you can't predict, but you can prepare. That's, of course, Howard Marks who said that. And I think that it's extremely relevant with what we're doing here. You need to maintain diversification in your portfolio and ensure that you manage risk properly.
Liam, thank you very much for that. There's a couple of questions coming in from the audience, which I'll get to in a second. But Walter, if I can maybe start with you. And it's always a story, you know, but is it different this time around or not? And I mean, the message from both of you very clear. You can't time the markets. We all know that. You've shown both very interesting slides and how it doesn't work. Walter, the slides of yours, the best days, the worst days. We've seen that as well. And you refer to what's happening at the moment as, oh, well, in a lot of his circumstances, you know, noise in the market. But it seems like the world is structurally changing. So is it necessarily noise this time around, or are we in for a structural change where global supply chains changes dramatically, and it can potentially have a huge impact on companies' ability to grow earnings?
Yeah, Eugene, I'd agree the world is changing, and the world is changing structurally. I mean, but that's always been the case. I mean, if we go back to when I was at school, which is quite a long time ago, you know, there wasn't such a thing as mobile phones, cell phones. You know, right now we have an aging population, so the world is getting older, and we have AI. So there is other structural elements to what is happening in the world. The world has also moved more from physical assets to intangible assets. And as I've said, some of these are less prone to some of the tariffs and supply chain constraints that we're seeing. So again, if you look at some of our funds, where we invested is in technology, and technology is perhaps not it's not going to be stopped at a port. You know, you need something completely different to stop the movement and sale of technology. Yes, there is other things that's out there, but ultimately, you know, the world self-corrects. The markets self-corrects. Governments ultimately become rational. The markets will force these rationality onto it. We can't have the whole world starving because food can't move. Yeah, it's just, I think the behavior is we need to be rational about these things. Yes, there is a lot of noise that makes people very uncertain. And again, I'll go to the example of COVID. I mean, COVID was quite extreme, like lockdowns and things like that happened. But ultimately, the world saw you can't continue like this. And and it normalized. And so I think you have to have that mindset, is that ultimately things will self-correct. Ultimately things will come right, and just don't, as Liam said, do the irrational thing at exactly the wrong time, because that can inflict permanent damage to your wealth. Eugene, you're on mute.
How did that happen? I'm sorry about that. You both made that point as well. Don't be irrational at this stage. Let the dust settle, and there's still opportunities out there. But Liam, if we can maybe talk a little bit more about SA equity. You mentioned, we are in a low growth environment. We know that the IMF downgraded global growth for mostly all countries, including SA. Our Minister of Finance, beginning of the year, said about 1.8%. IMF downgraded us to 1 and maybe lower. We know things like GOA is probably out the door, which will definitely have an impact on SA in some regions more than other. But again, it speaks to things like back to things like growth on earnings. If we're in a lower growth environment, are there companies that you look at that are possibly more defensive and maybe not as affected by lower growth environments?
Dean, that's a good question, because that's essentially the environment we've been in for 10 or 15 years as SA equity companies anyway. So we've seen these resilient and robust returns and outcome coming from them. And so it's, in short, what we've been experiencing. We're sort of battle hardened already for what might come. What we do see, though, in our market is just the shift between financials, industrials, and resources all performing at a different time. And that's very much what drives what happens in our market. We're a very macro affected market. Like, we can sit here and talk all day long about what the ANC might do and the effect that GOA might have, and does GNU break up or not, and does it even matter? And then you'll have something like Putin invade Ukraine, drive commodity prices up through the roof, and suddenly the rand is sitting at 14.60, and we have current account surpluses. Certainly not the safe haven asset people would have thought when geopolitical risk strikes. So that's what comes back to this idea that you need to remain diversified and be extremely careful about taking strong views in a market where you actually don't know how it's going to respond. It's not a rules-driven market in any way. There's sentiment and human behavior and emotion that essentially drives it. And that's why I haven't unpacked all of our risk management. But if you want to understand how we do that, we can dive into all the detail of it at some point and really unpack how do you manage risk when you're saying, I can't predict, I don't know what's going to happen, yet still drive good outcomes for investors.
Liam, on that point, and maybe one of the questions from the audience regarding your risk versus return graphs, we can maybe unpack that a bit more. What metrics are you used to determine risk taken on those graphs?
I think it's a very good question, because it's something that the market wrestles with. So I've stated it as risk. The reality is it's a proxy for risk, because risk just speaks around the range of uncertainty, that you could have multiple different outcomes for a very similar starting point. The risk that we use is volatility of the asset class. It's a fair proxy. We've dug in and investigated a number of times and leaned on research as well. It reflects the idea of maximum drawdowns, getting more statistical. It does make some assumptions about a normal distribution, but it's a very fair proxy, especially over the long term, in what risk actually is in a portfolio. And then just to touch on that, it's a fair comparison across the board for all of those portfolios that I showed. All those are CISA category peer funds were all being measured on exactly the same risk return basis coming through there.
And I mean, that is something that I know that PortfolioMetrix has been developing over more than a decade now. And if I look at your fund range, you've got a comprehensive fund range. Those funds actually plots on an efficient frontier. So the matrix or the process clearly works. Maybe to get a little bit more into the funds, you both have multi-asset funds. Liam, you've got a couple of multi-asset funds. We're going to focus on your balanced fund. Maybe just in terms of your growth asset exposure, SA equity, global equity, it's sometimes challenging because, if you do asset allocation, it's always that relative question. Even if SA equity appears to be attractive, good valuations, the question is, but what can I get out of things like bonds? And if we listen to your colleague Philip Bradford, still very positive on SA fixed income. And we've seen that bear, bull case, base case scenarios, and based on that, it's still very attractive. But how do you make the decision currently when you look at things like SA fixed income with lower levels of volatility, possibly more certainty? Do I dare say that relative to things like SA equity and global equity, how do you make that call on what that mix should be?
So without going into all the detail of our optimization process and everything, in short, you can't forecast the returns you'll get, but you can rely on risk premia through the cycle. And essentially find equilibrium weight. So risk premia, it basically means equity should give you a greater reward for the risk that you take than bonds. But we're distorted here in South Africa because we at the moment can get inflation plus 8% out of our bonds. So when you're building a multi-asset portfolio, you start by saying, how much further into this risk spectrum do I need to go? Because the further out I go, the longer I'll have to wait for my return. So bonds will probably give you that 11% over the next 3 years per year. Whereas equities, we've seen with SA equities, it can stay very disappointing for a very long time. Global equities can reverse as well. Let's not forget the sort of 2000s where US equity disappointed for a very long time. And so that's the uncertainty you're buying into. You need to balance it. That's what a balanced fund is trying to do. It's doing it at the top end of the Reg 28 constraint, so you're high on growth assets. But where we've managed that and where we really did that was 2022, when the constraints were lifted on offshore. We increased our offshore equity, replacing some SA equity, because that trade was selling Naspers and buying the NASDAQ, essentially, far more diversified, global leaders, less concentrated. And then to make sure we weren't missing out on SA beta risk, we had a little more SA bonds, which has driven portfolios very, very nicely. Now, that's just a very light, high level of nearly 3 years ago, but those are some of the things that we do to manage risk in a portfolio and still drive returns.
Makes a lot of sense. Walter, if we can maybe again dive a little bit more into your All Seasons fund, which is in the SA multi-asset flex category. If I look at your net equity exposure at the moment, it's sitting roughly at about 90%. Given where we are, and I mean, you shared in your presentation, some of your views on equity, but in a mandate where you've got a lot of flexibility, why such a very, very high allocation to growth assets?
Yeah, Eugene, again, it's just, part of our philosophy is over time, equities is the best performing asset class. Over time, if you want to beat inflation, if you want to generate real returns, that's going to come from equity. And we understand that there is these drawdowns that happen, but if you're in a saver, if you're a saver as an investor rather than somebody that's going to be drawing down, you want that growth. And so yes, the equity exposure is high, but we understand that over time that gives us the best performing returns. And then secondly, what we do is we're quality investors, and quality businesses tend to sustain macroeconomic drawdowns much better. Again, so we can look at something like ShopRite, Clicks, Capitec. Those are all companies that, no matter the economic environment, they have clear growth paths because they have captured a segment of the market and continues to capture a broader segment of the market and can continue growing. So despite what's happening at the macro level, you can always find businesses that do well despite what's going on around you, and that's what we attempt to do. So rather than try and and play around too much with asset allocation. We'll say, what is the type of mix that we want to be exposed to that's going to give us the growth, and that's going to have where we can mitigate some drawdowns. But then the second layer is what you're doing at the company level, and focusing on those businesses that can grow no matter the economic outlook.
I want to touch a little bit more on global equity specifically, and both of you have specific global equity mandates or standalone funds. Liam, you also use it as a building block in your balance. Walter, the same with All Seasons Fund, you use your global equity as a building block. But let's just talk a little bit about global equity. And Walter, I first want to stay with that with you. If we look at what happened, in global markets past 4 months, it almost appears as if the UK or European markets were a bit more resistant to or resilient with all this noise going on. And some might argue, that US equities got a bigger hiding because the markets were already expensive. So it's maybe not just a function of trade tariffs and uncertainty. It could be a function of, the US just being very pricey. I know that a lot of your exposure is based in the US, but is this a time to look at other regions like the UK, like Europe, where markets appear to be better priced and some of their sectors perhaps a bit more defensive in high levels of volatility?
Yeah, Eugene, I think we've had this question, I think for 5 years, people have been saying, well, the US is expensive, the US is expensive,
Yes,
shouldn't
I
we be
know.
out there? And yes, I mean, Europe has held up relatively better, but again, there's very certain sectors. So in Germany, defense, because the German government is going to relax on their economic policies and their budget constraints, and is going to spend significantly on defense. So you've seen those stocks rally significantly in the last 3 years. If you look at European auto, I mean, they've been hit probably as hard as some of the US companies, Volkswagen, Stella, you can name them. They've all suffered dramatically. And if you look at a company like SAP, and again, I'll go back a number of years, when enterprise systems first came into development, SAP and BARN was the preeminent software businesses. And over 10 years, they've actually gone backwards, where companies like Microsoft, ServiceNow, Salesforce, whatever, US-centric businesses has grown and overtaken a lot of these European businesses. So yes, Europe can be more defensive, but Europe as a culture is very conservative, and their economic policies and their way of doing business is a lot more, you could say, on the socialist side of things, where the US is more entrepreneurial. And you find that these companies in the US are much more prone to take advantage of any economic opportunities. And so, yes, we remain heavily invested in US listed businesses. These US listed businesses is, quite a large portion is exposed to software and tech, if you want to call it that. And they do business all over the world. And so I'll say that. And similarly, the large European businesses, luxury, etc., they also do business all over the world, and they're probably more prone to what's going to happen at the tariff level.
Well, thanks for that, Liam. Maybe if we can look at your global, you did mention that you're up your global a little bit. So you took away from SA equity. Your global exposure, I know there's always questions about China. I mean, again, what's that pond that you fish in for global? Do you screen the entire universe? Do you look at things like emerging markets? And what's your views on emerging versus developed markets, for the next 12 months or in the current environment?
Thanks, Eugene. So again, this idea that you cannot predict, but you can prepare is important for us. So we really look to diversify. Now, how do we cue that diversification in our portfolio or set this neutral type position that we need? By and large, the All Country World Index gives you a very good starting point. And that's your aggregate view of the market saying, this is how we think capital should be allocated. So that is where we start. But where we differ is that we all then say, okay, fine, there's certain regions in this world that justify passive implementation. Equally so, there's certain regions in this world that justify active implementation. So it's never passive versus active with us. It's where can we find the best tools to implement what we want to do. So the US large cap space is a good example where you by and large want passive because you don't know when it's going to turn. You could have said any time over the last 10 years that it was too expensive, and you would have been wrong for 10 years. So you need to manage that risk of missing out and manage that risk of being too overweight as well. And when that momentum trade unwinds, get hurt. The challenge with saying, okay, now I want to allocate perhaps to European luxury goods is that it's also too late because that, although they've gone negative, but that's played out year to date because the allocation has already happened. So you need to be diversified without sort of sticking to the same event all the time. But when Putin invaded Russia, it was emerging European equities that outperformed everything in dollar terms. It was the best performing region. What we're seeing at the moment is frontier markets outperforming. So how do you forecast these? You can't. You need to manage the risk in the portfolio, make sure that you size everything correctly so that if and most likely when you're wrong, you don't inflict damage on clients' money, but instead you slowly chip away consistently and build good returns for clients, essentially win by not losing.
Liam, thanks. Let's just talk a little bit about the dollar because the behavior very strange indeed. If we beginning of the year, I think a lot of people said, the dollar is going to keep a lot more value, uncertainty in the world, it's that flight to safety. But we've seen a big reverse on that. I mean, people started buying Swiss francs, they started buying yen. People bought gold. I mean, it's been mentioned here as well. We know what gold price has done. Behavior of the dollar going forward. I mean, how do you work that into portfolio allocations, especially if you look at your global component? Do you think that the dollar will remain structurally under pressure? And is that an overlay that you do consider when you allocate to global, Liam?
Sounds like you're pushing me for a forecast. What we do know is that the dollar's down 10%.
Not at all.
The dollar is down 10%, but it's extremely interesting because the shift in US Treasury yields in the dollar, and as you said, not behaving as a safe haven asset, puts a big question mark there. Because in COVID, you had this dash for cash. The dollar got extremely strong. The rest of the world's currencies got weak. Now you're seeing a weakness in the dollar, strength in DM currencies, excluding the dollar. And emerging markets, if you look at the rand, kind of holding up quite nicely despite this huge disruption to the world. So I think that starts to speak to a reconfiguration of the world. And as Walter said, eventually the market settles and finds its natural equilibrium again. Perhaps a little less reliance on the US as an example, but a lot of that was triggered when the US weaponized the dollar and made all the other countries rethink how they handle the dollar and what assets they hold in dollars. So it is an interesting one. You can find lots of speculation around it. The reality is a weaker dollar is going to most likely be good for a South African investor because generally that favors emerging markets. It props us up a little. It means that the demand on servicing hard currency debt, of which South Africa doesn't have a lot, but other emerging markets do, suddenly that burden drops. It just becomes a freer, more liquid environment for the rest of the world. And it's indicative of capital flowing out into the rest of the world as opposed to going and drawing back into the US and leaving us all out in the cold.
Gentlemen, I'm going to pause this conversation here. I've been very naughty pushing our boundaries on the time limit. I'm sure there's a lot more questions we can actually unpack or discuss. Very interesting times that we are in the moment. Both of you, like I mentioned to the audience as well, you do have multi-asset mandates. So with BlueAlpha, the All Seasons Fund, you've got a balanced fund as well. All the funds are on the platforms. PortfolioMetrix specifically spoke to their balanced fund, but again, they've got a whole range of portfolios and solutions. I see there was a couple of questions from the audience as well, Liam, with regards to your process and how it works. Do our audience know how it works by now? You're more than welcome to get hold of us. We'll get you in touch with either Walter or Liam if you want to unpack their views a bit more and more specifics on the funds. To Walter and Liam, thank you so much. Been very insightful. And the key message: you can't time these things. You can't forecast. Remain invested. If you're not sure how to do that asset allocation, give it to the experts. Their funds are on all the platforms. To our audience, thank you so much for joining. We'll see you next week, Wednesday, 7 May. We continue discussions with Cartesian and Platinum portfolios. All the slides will be made available as per usual, as well as the recordings. You will receive a thank you note with the links to all of that. Thank you so much, and I'll see you next week, Wednesday. Liam, Walter, thank you very much.